I'm going to sort of leap into the body of my talk. And so, in one of the more famous passages in Souls of Black Folk, Du Bois wrote, "To be a poor man is hard, but to be a poor race in a land of dollars is the very bottom of hardships." Now, if Du Bois's words rang true during the industrial era, they likely resonate even more today. With the financial economy representing a greater share of GDP than ever before, Black Americans are living through and facing the greatest period of financialization in US history. Now, as Bernie Sanders reminded the nation last year during the presidential debate, the median net worth for Black households was cut in half during the Great Recession. Not to be outflanked, Hillary Rodham Clinton quoted equally devastating statistics about racial wealth, citing, for example, that as of 2016, the typical Black household owned 8 cents of wealth for every dollar owned by a white household. Now, with only 1 out of 11 of Blacks under penal supervision of any sort, we may or may not live in an incarceration nation. But with a typical Black household owning a mere 8 cents for every dollar of wealth owned by a white one, we assuredly live in a broke Black one. Now, today's talk will excavate the recent historical forces that explain how we arrived at this contemporary moment of seemingly intractable inequality, evidenced in a racial wealth gap that is nearly its widest margin since the federal government began collecting this statistic about sort of 30 years ago. In the key role that fees and other related expenses have played as a driver of this gap by both extracting wealth on one hand, but also increasing barriers of entry to upper mobility, particularly in the African-American community, on the other. Now, before I enter into the body of my talk, I'm going to provide us with a brief sort of roadmap. First, I'll talk about the project sort of questions and origins project of my research. Then the intervention and methodology, thing that scholars love to do. What is my contribution? And then I'll sort of talk about sort of a summary, a synopsis of the book, and then provide a sort of a case study, a detailed exploration, and then just a few words about the racial wealth gap in sort of Trump's America. Now, this research project originates out of a set of sort of questions. How, following years of record home ownership, and record home ownership is typically the most reliable builder of wealth in a free market private property economy. So why after years of record home ownership has wealth disparity only increased? And why has education in particular, historically society's sort of great social leveler, contributed to the gap rather than mitigating inequality? So with these sort of related questions in mind, the broader project examines policies in 4 areas of central upper mobility: housing, employment, education, and transportation education. Now, each is a critical area of interrogation because each has provided a traditional path to upward mobility in our society. Now, let me be clear that policies in these sort of 4 areas did not create wealth inequality or economic inequality, but they've sort of dramatically exacerbated them. Now, central to my research is a study of a rise of a cryptic collection of fees and charges paid by quarantine consumers. And by quarantine consumers, I'm talking about consumers who are cordoned off by race, gender, geography, or class. Now, partly for this reason, even at moments in a nation's history, when we see that, let's say, income gaps between women and men might close, we see that the wealth trends, particularly in the 1990s, for example, continue to grow between these same groups over the same period of time. I want to sort of argue that these sort of fees sort of function as a tax. And they function as a tax in sort of 3 basic ways. And this is a subject some of us are more familiar with than others who are on a college campus. First of all, it functions like a de facto tax because A, they're difficult to opt out of, right? When you go at many universities, Emory is probably one of them, and you pay your tuition, there's this thing called a registration fee. And I'm a professor, I've taught at a few universities, and you can't sit in my class if you pay your tuition but not your registration fee, right? So you can't opt out of that registration fee, so they're difficult to opt out. Secondly, these fees often serve to generate, for the public sector, revenue, right? And it's increasingly a concern at both the state and the federal level. And for the private sector, they generate profit. And this is a story in Ferguson. Again, I just moved to Missouri. Missouri, there's something called the Hancock Amendment, in which basically you can't raise property taxes unless the elected official puts stuff up for a vote. No elected official wants to say, I'm going to raise your taxes. See George H.W. Bush in the 1990s, right? And so they increase fines as a way to circumvent the public eye of raising one's taxes. And thirdly, these fees serve to transfer wealth. And we see this through things like auto insurance. I mean, transferring wealth from impoverished populations to wealthier ones. Now, I want to sort of say that the aggregate burden of this sort of de facto tax is a key yet heretofore driver and mechanism of widening wealth disparity over the last 4 generations. Now, the erosion of consumer protections and a concomitant rise of fringe financial services in the 4 areas I examined are linked to sort of deregulation. Now, during the mid-1970s, the federal government enacted a series of laws designed to stop racial redlining and encourage the expansion of consumer financial services participation in underserved communities. Yet about the same time, this effort to democratize credit was matched or followed by an effort to remove accountability from government to the consumers. And this sort of toxic alchemy, a genuine effort to democratize credit on one hand, without the watchful oversight of the federal government on the other, produced a new fringe financial sector, one that shifted practices away from sort of traditional practice of denying credit to extending it credit on high-cost terms. Now, as for my project sort of intervention, my project seeks to sort of layer the sort of generative insights of historians and urban policy scholars. Now, these scholars have sort of made perceptual contributions to what I call the sort of, what scholars have called the sort of cash value of whiteness and the impact of outmigration of middle-class role models has had on material conditions of urban and inner-city citizens. But perhaps the time has sort of come to sort of pierce the current narrative behind the urban underclass, sort of given what we witnessed in the last sort of 15 years in urban pockets throughout the United States. For if that thesis is true, and that thesis basically is that the most stable elements of the urban neighborhoods have all sort of migrated out in the post-civil rights period, what then explains the sort of near-epidemic spread of mortgage and home equity lenders throughout America's inner cities, cataloged in books like Confessions of a Subprime Lender. And what these equity lenders are looking for are people who've built equity in their property. And to build equity in the property means you've lived in your houses for years and years and decades. This is the story of really the subprime market in the 1990s all the way through or mid-2000s. Look at people who've been in their houses for decades, not people who just moved in. These most stable elements of the black community in urban cities. Now, secondly, a central concern and challenge of any interrogation of this era is to retell this history about the role of state action in exacerbating inequalities. And here the role of state action, I'd argue, is the role of deregulation. And that requires state action. States must come in to change local, state, and federal policy. It requires state activism. So to retell this story about the role of state action and deregulation without inadvertently expanding and advancing a narrative of state failure, a narrative that may have an unintended or downstream consequence of corroding trust in government and helping to legitimate what scholars have called, like Michael Katz have called, an interpretation that could be appropriate to reduce the size and influence of government and to privatize public functions. They justify government as failure, so we need the private sector to do this. Moreover, this book has implications for what I call the problem of deregulation exceptionalism in the study of contemporary black experience. And here, by deregulation exceptionalism, I mean the tendency to treat financial regulatory enforcement differently, if at all, from, say, civil rights enforcement. So, for example, a number of excellent studies about blacks' lack of access to credit in mortgage markets since the 1960s accurately assess the role of civil rights legislation since the 1970s, aimed at addressing consumer financial needs of underserved communities, and probably the most famous one is Community Reinvestment Act, which many people sort of blame for the rise of subprime. But the literature has been far too silent about how financial deregulatory laws that are ostensibly unconcerned with race, may also have a disparate racial impact. If the history of New Deal policy has taught us one thing, it's that federal policy is rarely, if ever, sort of race neutral. Now, as for the overview of the larger project, like most historians, the methodological spine of my work is chronological, spanning the sort of gilded age of financial deregulation, circa 2008 to 2000, from 1980, I should say, to 2008. I'm going to talk a bit more about post-2008 here, some of the Obama years, but also what we're currently sort of experiencing. But the focus of the book is primarily that sort of window. In four spheres of contemporary life, as I mentioned sort of before: housing, employment, transportation, and education. In each of these sort of four spheres, what we see is how deregulation has erected high-cost barriers of entry, the disparate impact these deregulatory policies have had on Black America, and ultimately how policy choices have eroded traditional pathways to upward mobility. The book, like today's talk, sort of begins at home. I'm going to try to go through this phase fairly quickly because we're probably familiar with much of this literature. Now, we all know that, again, that homeownership exists as the main source of wealth accumulation in our society. And even though homeownership rates are lower traditionally among African Americans and other populations, right? The few assets that are owned by Blacks are actually owned primarily in homeownership. 92% of Black wealth is largely in home ownership. And so this sort of asset concentration of home ownership meant that Blacks were extremely vulnerable to consumer financial practices that extracted wealth, practices like subprime, a crisis that has been more detrimental and devastating to Blacks than society at large. African Americans are sort of 3 times more likely to take out a subprime loan. And what we know about subprime loans is that subprime loans are more likely to lead to defaults. More likely to lead to foreclosures, and defaults are more likely to lead to foreclosures. Now, as you may also be aware that the key drivers of foreclosure are these creative mortgage instruments, things like balloon payments, prepayment penalties, adjustment rate mortgages. These are far more likely. So if you have a balloon payment in your mortgage contract, I'm not sure if you can hear me back there. I'm projecting now. A balloon payment in your mortgage contract is 30% more likely than a conventional contract, which doesn't have a balloon payment, to lead to foreclosure. On and on and on. These are destructive sort of financial instruments. And they all propose far greater risks to foreclosure than a conventional mortgage contract. Now, these destructive financial instruments were brought to the national mortgage market by something called the Garn St. Germain Act. Balloon payments, prepayment penalties, adjustment rate mortgages. They may have existed in states here and there, but what made it national was this Garn St. Germain Act, signed in 1982. And I'm going to talk about these mortgage products as sort of as fruit from a poisonous tree. I'm going to talk about how that tree gets poisoned of the passage of this Garn St. Germain Act. The abusive career of the Garn St. Germain Act stems directly from its troubling legislative origins. A 1982 law that intentionally favored lenders over borrowers. And this law, while lawmakers may have officially voted for it, the law was effectively conceived and written by the financial services industry. So not surprisingly, Chicago Tribune, for instance, fittingly labeled this law when it was passed, quote, an aid bill for the financial services lobby. I'm going to talk primarily about the gentleman in this light-colored suit. I'm going to talk a little bit about the gentleman in the pinstripe, but primarily just gentleman in a light-colored suit, Ferdinand St. Germain, or Freddie St. Germain, as he was known as today. I'll just stay here. Now, St. Germain sort of, let me just say, his public service as a Rhode Island representative, St. Germain was from Rhode Island. Public service as a Rhode Island representative made him a millionaire, basically. And he was a son of a dye factory foreman, an immigrant, but he was House Banking Chairman, and this sort of kicks money back to him. Specifically, St. Germain's close ties to industries regulated by his committee helped make St. Germain one of the two biggest recipients for campaign contributions from the three financial pacts. And as you can see, St. Germain becomes House Banking Chairman around 1980, right? Who's news he's going to say House Banking Chairman 1980? And look at the money for his campaign just rise up and increase. And so it again nearly triples and nearly doubles. What we also notice is that a watchdog group would say that St. Germain would get 9 times more funding for his campaigns than the average House member. And this is exclusively because he's the chairman of the House Banking Committee, which is making all the decisions about mortgages and broader financial issues and discussions. Now, the bill's co-author, Utah Senator Jake Garn, was equally implicated for pay-to-play scheme. For example, in 1987, the Garn Institute of Finance was opened at the University of Utah, thanks almost exclusively by contributions by the financial services lobby. Now, funding tax-exempt foundations like the Garn Institute illustrated another way the industry kept access to legislators who were writing banking laws and banking rules in an effort to circumvent newly created campaign finance laws. So what? What does this mean for African Americans? Why should African Americans care? What's this implication? For African Americans, still porous campaign finance laws that enable Garn St. Germain ultimately prove costly. Now, blacks would be among the most vested stakeholders in the subprime housing market, as I sort of mentioned before, right? Yet, despite having the most to lose, they held little sway over policymakers, in large part because of the financial service resources mobilized by Wall Street. You see, over the last 30 years, the financial services sector has been by far the single largest donor to national campaigns, contributing over $2 trillion since 1990. By comparison, blacks on average have contributed only pennies per household to candidates. And what the scholarly literature shows is that campaign contributions translate into some influence over policy debates, if not actual policy decisions. In both national capitals, both the state house, both the Washington, D.C., but also in state capitals across the country. And the growing presence of money in D.C. and state capitals further isolated racial minorities from the corridors of power where decisions were being made about Black America's financial fate. And given the growing influence of money, blacks' limited wealth likely put them at a greater disadvantage percentage-wise proportionally than their population numbers and actual voting numbers. You see, in the post-voting rights world, we need to see the rise of the donor class has emerged as yet another bulwark against black electoral power, alongside other mechanisms like at-large elections, political appointments, felony disenfranchisement, and voter IDs. Now, the origin story of the Garn St. Germain Act and the most commonly utilized subprime mortgage products, destructive products that it produced, is so awash in industry money that it's difficult to legitimate and sustain any serious defense of the law's design. Now, housing has been one tool that families have utilized as a means to improve their lot. Employment is clearly another. Yet over the last generation, the median wage in the U.S. has actually fallen. According to the Bureau of Labor Statistics, in 1970, a non-supervisory worker earned $18.08 per hour. That same non-supervisory worker earned 27 cents less by 2007, before the eve of the Great Recession. And so we all know that individuals and families have responded in various ways to offset wage stagnation. We work more hours. Right? When individual working more hours is not enough, right? We go to the spouse has to work. We have 200 households. Now we're going to 300 and 400 households as we send kids to work or send grandma or grandpa to work in their houses, all trying to make ends meet. And when that's not enough, of course, we turn to tapping our home equity lines, right? To fund differences and to pay for college. But what has often been sort of minimized or overlooked is the ways in which the free market system has responded to the issue of the growing gap between income and expenses. And perhaps the most ubiquitous response by the free markets to the structural problem of wage stagnation has been the proliferation of payday loan stores. Now, on the eve of the crisis, the number of payday loan stores outnumbered both McDonald's and Starbucks. These two establishments and barometers of modern-day middle-class consumption. And just for a quick primer, I mean, what's a payday loan store? A payday loan is a sort of short-term cash advance, typically made by sort of non-depository lender, i.e. not a bank, in which borrowers pay an APR, interest rate plus fees of often 150 to 800%. And it's called a payday loan because it's due when your next payday is due. It's due in 2 weeks when you're expected to get paid. And these payday loan stores have a disparate racial impact. These stores, the primary ethno-racial composition is the primary indicator where a payday loan store is located. Black and brown communities are 8 times more likely to have a payday loan store than white ones. Blacks specifically are good. Blacks specifically again, are 2 times more likely to even have one than Latino or Asian communities. Now, the free market cure for wage stagnation may have only sort of worsened the problem. One recent study shows that a payday loan borrower was twice as likely to be put further behind in their bills and filing for bankruptcy than if they're approved for a payday loan. In effect, so the bottom line is that you're far better off being rejected or denied a payday loan. You're far less likely to go into bankruptcy if you deny a payday loan and actually get approved for one. The typical borrower spends about 212 days indebted to his lender, racking up countless fees and charges. And by the time a borrower finally repays, she or he is actually owing more in fees than the original loan principal amount. Now, this sort of financial bloodletting makes it far more difficult for families to pay a mortgage or rent or cover other financial liabilities, creating yet another financial hurdle to increasing personal savings that are necessary for such long-term wealth-building investments like, buying a house or owning a house. And what is sort of forgotten is the role that deregulation over the last 2 decades has played in the explosion of usurious lending practices. And I'm going to look at one bill in particular, the Graham-Leach-Bliley bill passed in 1999. So what did this do? How did this have an impact in the rise of payday loans? Well, again, Graham-Leach-Bliley basically sort of removes what's called a firewall between banks and other financial institutions. And this creates an incentive, right, for banks to pursue large-scale, right, clients and institutions. When I was growing up, State Farm was what? An insurance company. Now I hear that State Farm is also a bank, right? And this because of things like Graham-Leach-Bliley, which removes this firewall between banks and large-scale financial institutions like insurance companies, security firms, investment banks. And so as banks start pursuing these large-scale institutional clients and investors, they turn their back on the retail customer, folks like you and me. And so this demand is sort of met by payday lenders. And so what happens next is that deregulation allowed these sort of same banks to then turn around and to contract out what's called the government-issued charters to payday lenders. Now, for payday lenders, these strategic alliances or rent-a-bank arrangements, as they were called, these government-issued charters that they were able to get, why did payday lenders want them? Because they freed payday lenders from much tougher state usury laws. Every state basically has real tough usury laws saying you can't charge interest above 15 or 25 or 30%, something like that, or 35%. These bank charters allowed them to charge much higher interest rates. And so, what did the banks get from renting out their charter? This is an ad from a trade magazine, American Banker. What banks got in exchange for renting out the charter were promises of returns of as high as 25%, or double the rate made by traditional investments. We see this from the check and go bank ad of early 2000s. Again, 25% as opposed to 12 or 13 or 14% return on investment, return on equity that banks traditionally got. Now, despite the media attention paid to financial products like home mortgages and payday loans, nowhere is a de facto hidden consumer tax more commonly assessed but so little discussed than in the realm of auto insurance. Now, Americans are far more likely to own or drive a car than to have a mortgage or to take out a payday loan. If you live west of the Hudson River, that's like 90% of Americans. The vehicle that literally links you to home, to school, and work is the automobile. The car is the most commonly held non-financial asset in the United States. Second only to a home, it's the most durable good and necessity that consumers purchase. And by law, in almost each state, every car must be insured. Right? And so policymakers should hardly consider lenders the most advantaged and promoted class. That privileged perch should logically be reserved for the auto insurance industry, an industry that occupies a unique and protected status within the American economy, and that it offers a mandatory good and service that's required by law to purchase, but is provided exclusively by the private sector on a for-profit basis. Not even health insurance has that. You can get Medicare, Medicaid, right? This is the only thing which has that, only product and service that has that sort of built-in advantage. Such public-private collusion resulted in skyrocketing premiums for insured motorists by the mid-1980s. And so what we find out is that the end result is that urban drivers wind up paying more for auto insurance than suburban ones. And you have to buy auto insurance if you want to drive. And so here again, Consumer Union sort of reported 2005 said that $900 more. And while $900 more, for instance, might seem like a modest amount, it was more than the Bush tax cuts of that time. A tax that was designed to sort of jumpstart the economy. And again, this $900 more a month you pay goes for infinity. Right? Extrapolate out for 50 years is almost $50,000. This is not like the proposed tax cuts of the GOP, which sunsets for working and middle-class folk after 10 years. No, this goes for infinity. And so, again, this kind of loss of accumulated wealth, the transfer of wealth. And what explains this is something called PC profiling in the auto insurance industry. By PC profile, I mean postal code profiling, and also PC profiling. It's no longer politically correct to profile people by race or gender or age, but it's still very effective to profile people by postal code, and still quite legal. And it's basing auto insurance on where you live as opposed to how you drive. And where you live is a non-merit-based factor. And merit-based auto insurance would be how you drive. Do I get into accidents? Do I get tickets? How far do I drive to show how well of a driver I am? And these non-merit-based factors are the driving force, or no pun intended, of auto insurance rates. Now, in the late 1980s, civil rights groups and consumer groups forged a coalition to pass something called Proposition 103. And Proposition 103 was designed to abolish the postal code profiling as a primary factor in rate calculus. And my research shows and chronicles how the insurance industry basically blocks the implementation of 103. It passes, right? But they never get to implement it. Especially nationally. So they block it in the state of California where the proposition gets passed, and then they also block it at efforts to impose it, to have it go national. At bottom, this story is not simply about the subtlety of postal code profiling and the transfer of wealth in American society, siphoning money from the deserving motorists, right? You go merit-based auto insurance, more deserving motorists, to less deserving ones. But postal code profiling auto insurance also exposes how the free market system, if left under or unregulated, may actually erode individual merit by rewarding the less deserving, as it does here in auto insurance. If we say we're a meritorious society and let's behave and act like one, and not just in higher education or immigration, listen, Trump wants to have a more merit-based immigration policy, mentioned a few weeks ago, but also in auto insurance, help us with intellectual consistency in insurance as well. Now, the fourth major area of my project, focus of sort of today's sort of case study, is in sort of higher education. Now, if the purchase of a home is the largest single investment one can make, a college degree ranks second. Now, normally we don't think of higher education as a mechanism of wealth disparity. Indeed, for much of US history, particularly since World War II, a college degree has been regarded as society's great leveler. However, this has slowly been changing in recent years as the growing costs associated with financing a degree have increasingly made college campuses less a site of upward mobility than of indebtedness. Now, fear of debt ranks as the number one deterrent of students opting out of college. And that's sort of with good cause. The average debt for graduating seniors with a student loan, and about 2 out of 3 college seniors come out of college with a student loan. The average debt in 2011 is about $25,000. And then buried in the contract of student loans is a trove of trick and trap fees that too often go unexplained by financial aid officers and go unnoticed by borrowers. And when I reference fees and charges for college financial aid, I mean add-on origination charges and deferment and extension costs. Again, my favorite, early repayment penalties. And these repayment penalties is when you get penalized for paying your bills early. Right? Imagine that, how counterintuitive that is. And default fines. And the end result for these trick and trap or TNT fees is exploding debt, resulting in students often owing 3 to 4 times the principal loan amount. And while the cost and terms may not necessarily be hidden, the financial aid loan application, the FAFSA form and process are so complicated that even President Obama's Education Secretary, Arne Duncan, admitted in his 2009 Senate confirmation hearing, quote, you basically have a PhD to figure out that FAFSA form. Now, I'm going to take a look at sort of 3 things here. I'm going to show 4 slides for 3 things. We're going to first look at who's borrowing. Then I'm going to show 2 slides about not simply who's borrowing, but how much this population is borrowing. And then the so what questions that historians like to ask. So what? Who cares? Why is it important? So first, let's look at, again, who's borrowing. Again, this is from 2011. Those numbers have actually gotten worse since then. In 2011, 8 out of 10 African Americans were likely to borrow for a student loan, compared to 66% of the average population. Most recent studies show that 9 out of 10 blacks are borrowing for college. So blacks are borrowing, are more likely to borrow. They're also more likely to borrow more. It's not simply that blacks are more likely to borrow, again, more likely to borrow more. Here, again, average African American debt is $28,000 compared to $24,000 by the majority population. And not simply that blacks more likely to borrow more, the borrower what industry considers what's called, quote, unmanageable debt. And unmanageable debt is basically 8% of one's sort of pre-tax income. Blacks and Latinos are more likely to borrow more unmanageable debt than the general population and white population. Now, if you're already experiencing a wealth gap and you're borrowing more money, again, you're extracting more wealth. And it's not simply so blacks are more likely to borrow more. So what? Why does this matter? As I mentioned beginning of my talk, home ownership is the primary driver of wealth in a free market private property economy. All this borrowing is delaying black home ownership. Why is it doing it? Debt to income ratio is a primary factor. So when you borrow more money, right, you have a higher debt to income ratio. That means it lowers your credit score. And with a lower credit score, that means you're either delaying home ownership and you're already behind the equity ball with whites. So they're buying the property first, building equity first, but you're also delaying home ownership as well. So this is exacerbating the wealth gap. So it's fascinating to me. I've talked to university presidents and they said, student loans are a good thing. You might borrow now, but you know what, you're better off than that person back in high school who didn't go to college. I mean, you've all heard the familiar sort of aphorism, a professor gives in front of class, says, look to your left, look to your right, one of you persons won't be here, right? That's because the peers are the people who are next to you, not someone you left back in high school. Once you get admitted to college, you get admitted to college because you've earned it. And so those are your peers. So you're falling behind your peers, primarily whites, who aren't borrowing as much. to understand the impact of that sort of reasoning and sort of logic. And they said, well, you paid it off in 10 years. The average person takes 20 years to pay off a student loan. And then if you take the homeownership, it's a 30-year mortgage. So now you're talking about not a 10-year student debt, right? But a student debt that has a hangover effect, a hidden hangover effect, or cascading effect over 30 years of the life of the consumer and borrower with higher mortgage points. And I've not even talked about the points you might pay, more points you might pay for a car loan, for any consumer loan. And so these student loans have this hidden hangover effect that people are slow to sort of talk about and to sort of engage. Now, and let me say this too. These numbers are even more dire for black women coming out of college, which is the only race and gender demographic which actually owes more than they earn out of 1 year out of college. And so also the intersectionality of both race and gender, and also throw class in there. It was not always this way. In 1977, for instance, only 1 out of 3 college students borrowed for college. By 2001, 2 out of 3 did. And let me say this is also about the 1970s and 1980s. The person more likely to borrow in college in the 1970s and 1980s was not the 8 out of 10 blacks. Primarily the person borrowing in college in the 1970s and 1980s was actually a white person. You want to know why? Pell grants. In 1979, for instance, Pell grants covered 77% of the cost of a public education. By 2008, Pell grants covered 1/3 of the cost of college education. And a private institution like Emory or Vanderbilt or Columbia, a private institution, the Pell grants only cover barely more than 10% of the cost of private education. Now, the origins of today's student aid crisis sort of has its roots in the 1980s, when the Reagan administration and conservative Democrats pushed through Congress a combination of tax and budget cutting measures. Policymakers employed fiscal stricture as a form of deregulation. And this is, again, we're having this conversation right now about fiscal policy, tax policy, budgetary policy. And they used fiscal stricture as a form of deregulation, reducing spending as a means to reduce the size, scope, and role of government in higher education funding, while enlarging the role of private markets in realms once governed by the public sector. These fiscal measures target in particular Pell grants, the grant program, as well as low-interest student loan programs. Let me say that several rationales existed to explain the need to slash aid to students and to reroute government dollars from grants, again, from grants to high-cost, fee-driven loans. Some argue that cutting aid, both grants and low-cost, low-interest student loans, would reduce the federal deficit, right? Others thought that less federal money would result in less federal intrusion. Still, others insisted that government aid upset the natural order of the nuclear family. This is the argument that Mitt Romney makes in 2012 when he's on college campuses in the spring of 2012, and someone asks him, what are you going to do about student loans? He's like, it's your parents' responsibility. So, it upset the natural order of the nuclear family, supplanting the parents in their primary obligation to provide for their children. Now, collectively, these views coalesced around a shared perspective, and that was that students were, quote, I'm quoting here, tax eaters and a drain on the American economy. From the White House perspective, the aim was simple. According to Education Secretary Terrell Bell, the goal was to reduce the federal government's financial commitment to the student aid system by, quote, pulling those leeches off the backs of decent, hardworking people, end quote. And whom did the administration regard as the leeches on taxpayers' backs in the 1980s? Well, these were not the usual suspects of the undeserving suspects in the 1980s. The mother on food stamps, the out-of-work father drawing unemployment insurance, grandma on Medicaid. It was also the upwardly striving college student in need of financial aid. And this view of student as tax eater signaled a dramatic departure from the federal government's public investment in students as future tax contributors, a long-held bipartisan belief that had dominated both parties' approaches to student aid dating back to Dwight Eisenhower in the early days of the Cold War. Now, nor did debates about the potential negative impact on Black America sway administration officials. Numerous studies and pleas from college administrators cataloged the harmful effects of rolling back the grant program would have on the burgeoning Black middle class. Even White House Special Assistant Elizabeth Dole, a rock-ribbed, steadfast Republican from the South, warned Education Department officers managing the budget that Pell Grants in particular were, quote, primary vehicles of sort of Black upward mobility. But the administration dismissed these concerns, making the political calculus that they were not likely to receive Black votes anyway. Now, under this new fiscal view of students as tax eaters rather than future tax contributors, higher education budgets were slashed while eligibility guidelines for Pell Grants and low-interest student loans were tightened in the 1980s. From 1980 to 1986, more than 250,000 first years were lopped off the Pell Grant rolls. For nearly 9 years running in the 1980s, the purchasing power of Pell Grants decreased as college costs grew and outpaced inflation. And as this buying power declined, what the Pell Grant covered shrunk as well, with aid shifting from grants to loans. And so as we see here, at the dawn of the 1980s, President Carter submitted his budget for the fiscal year with Pell Grants constituting 56% of total federal dollars allocated for student aid. By decade's end, when President Reagan proposed his fiscal year budget for 1989, the numbers are almost reversed, with loans now the majority replacing grants in the total federal dollars available for student aid. And these sort of trends continued for the next few decades. By the 1990s, federal cuts would have a sort of cascading effect nationally, as states began following Reagan's budgetary template, reducing state public expenditures allocated to higher education in an effort to cut state costs. And with governments doing less, the students' share of the cost of education spiked. The students and universities had to pick up the tab in the form of ever higher tuition fee costs. Consequently, borrowing was up for families and students at all levels of income, the steepest tuition hike occurring during periods of economic hardship when families could sort of least afford to pay. Now, financial deregulation may have helped to facilitate access by opening up markets and services and products to heretofore or underserved communities, women, racial minorities, working class, youth, immigrants. But inclusion has come at ever higher costs of entry, however. And for African Americans in particular, inclusion has become precisely those conveyances, housing, employment, transportation, that are thought essential for upward mobility in a post-World War II society. Now, sort of normally I might end with an anecdote from the 1980s about Pennsylvania Avenue and President Carter, who announced his first deregulation bill, but everyone ignored it because Roger Staubach, the star quarterback for the Dallas Cowboys, was retiring that day. To say about how little we pay attention to these sort of revolutionary sort of financial decisions. But today I'm going to sort of end on a slightly more contemporary note by talking about some final thoughts about what's happening today. Again, and it brings it back to issues of budget and taxes and regulatory policy first. I mean, and three things in particular. These are just sort of final muses and just things to think about. The ways in which the current administration and Congress might have an impact on the wealth gap. And one is with DoddFrank. Let me say what DoddFrank is. Passed in 2010, DoddFrank is the last major piece of legislation passed by Congress and signed by the White House. The first piece of financial regulatory reform since the New Deal. There are two things of Dodd-Frank which I think might be instructive and informative about impact on the wealth gap. One is something called the Maxine Waters provision, which calls for greater diversity in both gender and racial diversity throughout the financial sector as well as the regulatory sector. And what much of the public affairs and social science literature sort of shows is that representative bureaucracy matters, that it actually has an impact in terms of curbing abuses. And in particular, so again, that's a major concern. Second major concern is within Dodd-Frank, probably the best known instantiation of any agency created Dodd-Frank is the Dodd-Frank. Obviously, there's the Consumer Financial Protection Bureau. sort of started, or the brainchild of Elizabeth Warren. Director was Richard Cordray. And the CFPB is the only real federal agency whose primary objective is to protect consumers. That CFPB is now under assault, and one of the things that CFPB has really been aggressive and effective in doing is sort of curbing abuses of payday lending. And I'll talk a bit about payday lending here and the ways in which, again, rolling back the CFPB, removing some of its authority and enforcement powers could have a sort of detrimental effect on all consumers, and again, they could have a disparate effect on African Americans. And this is all part of a broader agenda to roll back regulations. The current administration has sort of unprecedented regulatory rollbacks in housing and education and retirement savings. And then finally, I'm going to just briefly say tax reform proposals. But then I feel kind of with Dorothy Brown sitting here, I feel like I can't talk about taxes. Dorothy Brown, I feel like I should sit down and let Dorothy take over. And here's sort of the bottom line is that income increases from the current tax proposal could happen for the one for those who earn incomes above $1 million. At the same time, you have after sort of tax sort of hikes for income earners making between $20,000 and $40,000. And of course, the median black income is between $20,000 and $40,000. Again, a disparate impact on African Americans. And so I could talk maybe a bit more about some Center for Budgetary sort of policy sort of arguments about how this tax proposal also could increase the deficit and the disparate impact that an increased deficit has on African Americans, given that the primary, most important vehicle for black mobility has been the public sector. And so by blowing a hole in the deficit, you're going to say, I have no money to spend on public employment, which is the main ways in which blacks since the 70s have actually been able to move into the middle class. I'll stop there, and I can open the floor for questions. Thank you. Thank you.